This leads us to the key message, which is selectivity. There is still value, just not everywhere. So opportunities in credit markets are there, they are ready to be picked, just they are not in the typical credit fund, they are not in the typical index. In the second half of 2026, we expect volatility to be on the rise, and as a consequence, we position our global credit strategies in a cautious and selective way. Since the beginning of the year, we had 50% upside in oil prices and a 10% reduction in the global supply of oil. Historically, these kind of movements are extremely recessionary. We had 5 instances in which we had this kind of adjustment, and in all instances, global growth was repriced lower by at least 2 percentage points in the subsequent 12 months. In 4 of these 5 instances, the global economy was facing a recession. Right now, we're seeing no sign of recession, with the first quarter of 2026 seeing nice economic activity and good earnings potential for all the firms. But typically, all the stress coming from oil disruption tend to come in the 2-3 quarters after the shock has started. So we expect a much more underwhelming second quarter and third quarter, and all the weakness to show up in the second half of this year. At the same time, global interest rates are very volatile again. We have inflation on the rise. We have 2 central banks, ECB and Bank of Japan, about to hike interest rates. We may see the same from Bank of Canada and Bank of England. And we have a big question mark at the Fed, but it's possible to find out that the new chairman can be way more hawkish than the market are broadly anticipating. So the environment is an environment in which risk markets, as we know, are at the highs, equity markets and credit spreads at the tights, and at the same time we have weaker potential for economic activity and higher volatility in interest rates. So overall, we should be careful to how we allocate money to fixed income and credit in the second half of the year. This does not mean we should ignore credit. We are in the middle of a big structural change, and in particular a big reallocation from government bonds to any other bond. As we know, in the past 10 years, government debt in G10 markets has exploded, has almost doubled, went from 70% back in 2008 to 120% today, and global curves are steepening, recognizing this risk. From the market lows of 2022, global duration has sold off another 25%, while investment grade, high yield credit, equity markets all rallied big time. So to us, this suggests that investors are recognizing the risk, which are basically a big component right now for government debt, and then they are switching gears from government debt to any other asset class. This trend will continue to go as government debt continue to be high. Global deficits in G10 markets are now around 6% vis-a-vis 3% just 10 years ago, and inflation is on the rise. So government debt and duration have way more limited value compared to all the other things. This leads us to the key message, which is selectivity. There is still value, just not everywhere. When you look at the overall credit spectrum, we see many areas where there is still some value. Just to mention a few, in UK markets, we can see more defensive sectors offering nice value after the big yield sell-off, for example, telcos and utilities. In European markets, single B names are still relatively attractive. In US, energy-related names are pricing in too little oil levels for the end of the year, so they are attractive, and European financials, not in every area, but in selected area, remain a good play. Emerging markets are also a big winner from the de-dollarization process we are seeing across the board, and in particular, local markets are extremely attractive. So opportunities in credit markets are there, they are ready to be picked, just they are not in the typical credit fund, they are not in the typical index, and so the average bond is not attractive, but very selected bonds have a lot of value.